Hello everyone. We are here to discuss one of the major topics for your syllabus. ACCA, as a very course itself says, the conceptual clarity of any subject becomes very important. Basically, your exam questions are purely going to be case scenario wise. Alright? And therefore, understanding any subject for that matter should be conceptually very clear. Alright? Now, today we are going to get started with audit and assurance, and we are picking up chapter 5, that is risk, or we call it to be risk assessment. Just to give you the importance of this particular topic for you, understand that in your examination for the subject audit and assurance, you will be having two sections. Section A will be having 3 questions of 10 marks each, whereas the section B is going to have 1 question of 30 marks and the remaining 2 will be of 20 marks. So this section B, which is purely a case scenario, one of those questions, they usually focus on the topic that we have chosen today, and that is risk assessment. And obviously we understand when you talk about case scenarios, without understanding the concept, without understanding the subject like the way it has to be understood, you will not be able to analyze any of the cases and give an answer. So more of theoretical is not the way we approach, more of practicality is what is the way of approaching. Audit and assurance being a very theoretical subject, it is actually more practical oriented. So our understanding as this subject should be purely practical oriented, and that is the reason when you come across case studies or case scenarios, you will be able to solve them with ease of understanding and simplicity. Alright, so with this, let us get started with chapter 5, risk assessment, or simply we call it to be risk. In this topic, we will be getting the entire knowledge of the term audit risk. We will be understanding certain terms connected with risk, and we also get introduced to certain international standards of auditing. So let us see first the overview of this topic, what this topic is going to teach us. So first in this topic, what we are going to study is about business to business, that is we are going to first begin with the need to plan and perform the audit engagement with an attitude of professional skepticism and to exercise professional judgment. So we will understand what you mean by the term professional skepticism. Also will come across the word professional judgment. These two words we already have an introduction in ISA 200 which we come across. Okay, so we have ISA 200 which talks about overall objective of the independent auditor and conduct of audit in accordance with standards on auditing. So there you come across the word professional skepticism and also the word professional judgment. Alright, so based on that you'll be getting the meanings of them. Then we'll be doing the main important thing, that is audit risk, that is assessing the audit risk, and the major part of this class will be focused on the term audit risk. And then we have something to do with ISA 315. It is going to tell us that if you need to identify the risk, if you want to understand the risk, you need to understand the entity, the environment, and the applicable financial reporting framework. Alright, so this we study as a part of ISA 315. Alright, so this is what first thing we will be understanding about some concepts connected to ISA 200. Then we will move on to the main part, audit risk, what you mean by it. And then we are going to move on with ISA 315. Along with that, you will also get introduced to something called as ISA 320, the materiality topic. Alright, but this is simply an overview. I am very sure you must have not understood much, but let us go in detail and let us understand every point in detail. Alright, so here understand, when we do risk assessment, we are going to talk first about audit risk. Then there is something called as professional skepticism. Then we are going to understand the entity. We will understand how to understand the entity, like there is something called as risk assessment that you do, which we will do by analytical procedures. And then we know everything in the organization is not going to be important for us. Only those which are material are going to be important. So every misstatement that we identify, are they going to be important for our judgment? No. Only those which are going to be material will be important for us, right? So basically in the topic of risk assessment, you will come across audit risk, professional skepticism as a concept, what do you mean by understanding the entity, then what is analytical procedure, and then we talk about what is the concept of materiality. Alright? So let us get started with the term audit risk. Before we move on understanding the term audit risk, I will give you a proper understanding of the concept, how it is connected, and how can you understand in a much better manner the word audit risk. Alright, now understand we have a standard ISA 200, that is International Standard on Auditing, ISA 200, which talks about overall objective of the independent auditor and the conduct of audit in accordance with standards on auditing. So they tell the overall objective, plus they tell auditor has to perform the audit based on the standards. Correct? So that is what is given in ISA 200. In ISA 200, when you talk about overall objective, that standard tells you that the auditor has to obtain a reasonable assurance about the financial statement. So we come across a word which we call it to be reasonable assurance. Okay? Now this word reasonable assurance very simply says that you will never be able to get absolute assurance. That means what? 100% you will never be able to give what? 100% assurance you cannot give as an auditor. You will be able to give reasonable assurance, and that is what we consider to be overall objective. Now, why we cannot give absolute assurance and we can give only reasonable assurance is because audit has a limitation. Correct? So, there is always going to be an element of risk. So, there is always going to be a risk which is going to be present. But we as the auditors are required to bring this risk to an acceptable lower level. That means, obviously, elimination of risk cannot happen. Just to give you an understanding, when you do the audit of the huge companies like Tata, Reliance, etc., they are going to have so many transactions. You take Amazon for that matter, lakhs and lakhs of transactions they are going to be processing on weekly, daily basis. In that case, tell me, you as the auditor, will you be able to check every sale, every purchase? Absolutely not. So in that case, we are going to resort to some of the procedures. One of them would be audit sampling, and because of which we will never be able to give absolute assurance. We will always be able to give reasonable assurance. But the audit syllabus or the standard tells that look, the audit risk will be there, but you as the auditor should try to eliminate or to try to minimize the risk to an acceptable lower level. And this acceptable low risk, how can you make? By obtaining sufficient appropriate evidences to support your conclusion. Correct? Now let us understand what we are trying to say. First, audit risk. One of the main requirements of the auditor is to obtain sufficient appropriate audit evidence to reduce the audit risk to an acceptable lower level. We understand reasonable assurance is told, but reasonable assurance does not say low level of assurance. There are so many people who are going to actually rely on the opinion that you are giving. So can you give them any kind of opinion and say reasonable assurance? No. Because if you do that and if you have not performed your audit in a manner to bring the risk low, then in that case, you have actually not justified your responsibility. Correct? So we know audit risk cannot be eliminated. We know it is never going to be zero. But we as the auditors are required to bring this risk to an acceptable lower level. And we know the entire audit, whatever conclusions you draw, is going to be based on evidences. And these evidences have to be sufficient and appropriate audit evidences. Correct? So what we say, very simple. How is audit conducted? Always, you plan the audit. You obtain evidences. From the evidences, you draw conclusion. And then from the conclusion, you give opinion. Correct? So you do planning, and in the planning, you'll do what? You plan the procedures. From the procedures, you will obtain evidences, that is audit evidences. From the evidence, you are going to draw conclusions. From the conclusions, you turn up to the opinion. Correct? So, these evidences which you are going to obtain, they have to be sufficient and appropriate audit evidences. Correct? So, understand what they are telling you. Obtain sufficient appropriate audit evidence to reduce, nowhere they use the word mitigate or eliminate. You can only reduce the audit risk to an acceptably lower level. And this I told you we discuss as a part of ISA 200. So when we take ISA 200, we will even better understand what you mean by a reasonable assurance, what kind of opinion we have to give, why do we not get absolute assurance, what is the reason behind it. All of that we discuss as a part of ISA 200. Now comes to the main element of our discussion, which is going to talk about audit risk. Now first tell me, what is risk? Risk is the probability or the possibility that something is going to go wrong. It is risky, we say. Risky means danger involved. Correct? So in a layman's language, when you talk about risk, risk is something which is going to be problematic. Correct? So when I say it's a risky situation, ये भी हो सकता है, this also can happen or that also could happen. Right? So when we say that, we say audit risk, that means something can go wrong on the part of the auditor. It is risky. That means we as the auditors are going to go and give opinion on the financial statements. Correct? If this opinion we give wrong, that situation we call it to be audit risk. That means you are giving unmodified opinion. That means you are telling what? It's unmodified opinion. That means you are telling everything is true and fair. In reality, financial statements are misstated, materially misstated. That means the audit opinion that you have given is inappropriate. And this situation, we call it to be what? Audit risk. So very simple, audit risk simply says that when the financial statements are audited by the auditor, the opinion that he gives, suppose he has given unmodified opinion, but in reality, the financial statements are materially misstated, then this situation, what has happened, we call it to be what? Audit risk. So very simple, the risk that the auditor will end up giving an inappropriate opinion on the financial statements when they are materially misstated, we call it to be a situation of the audit risk. Correct? So what is it? Let's have a reading. This means that they give an unmodified audit opinion when the financial statements are materially misstated. So you gave unmodified opinion, but in reality, there is material misstatement involved. So this is what? Audit risk. The risk where the auditor has given inappropriate opinion. Then, if this were to happen, the auditor could be sued by the intended users. Now tell me, if you end up giving inappropriate opinion, and because of which maybe some investors believed and they invested in a particular company simply relying on the report given by you. And maybe the banker has given a loan, or maybe investment has happened, or the government authorities have trusted on the particular financial statements. Tell me, in that case, if your opinion turns out to be wrong, and that too because you have not obtained sufficient appropriate evidences to support your answer, then in that case, all possibility that people will sue you. Sue you means what? Drag you to the court of law. Correct? So you would be also, if this were to happen, the auditor could be sued by the intended users, investors, bankers, creditors, anybody. Disciplinary actions could be taken by the relevant professional bodies. Relevant professional bodies are the bodies which are actually regulating the auditors. And the firm could damage its reputation. Understand that auditors, by the very nature, work by their reputation. No reputation, no credibility. If you do not have the credibility, the report that is issued by you, will that be credible? Absolutely not. Correct? So here understand, it becomes very important for you to take all the proper procedures to reduce the audit risk to an acceptably lower level. Correct? So what they say, to avoid these potential damaging consequences, the auditor will plan and perform the audit in such a way that the audit risk is reduced to an acceptable lower level. Very important word here is reduced. Elimination can never happen. looking at the size, the nature of the organization, impossible for any auditor to do 100% checking. We don't even have time. It is so expensive, it is going to be uneconomical. And you are not having only one client, you have multiple clients, correct? So in that case, it is not going to be possible for you to eliminate the risk. So you have to reduce the risk, and this risk should be reduced to an acceptable lower level. Acceptable means what? These intended users should be ready to accept, correct? So acceptable lower level. All right. So this is what the meaning of the word audit risk. Now let us understand what is the audit risk made up of. So we call it to be components of the audit risk. So audit risk basically is made up of three components. Okay. So we have basically three components. We have inherent risk, then we have the control risk, and then we have detection risk. Alright, now inherent risk, control risk, detection risk, these three together will make an audit risk. That means the presence of these risks, it could bring rise to what? Audit risk. That means auditor could end up giving what? An inappropriate opinion on the financial statement. Then you need to understand the relationship. Inherent risk and control risk together, we call it to be risk of material misstatement. What is inherent? What is control? We will study. As of now, let us understand the relationship. Inherent risk and control risk, when you combine them together, we call them to be risk of material misstatement. And when you combine this with the detection risk, these total will move on to what? The audit risk. So audit risk basically is the combination of risk of material misstatement and detection risk. Alright. So if you read the language which is given in the content, it says audit risk comprises of risk of material misstatement and detection risk. And when you talk about risk of material misstatement, it is nothing but inherent and control risk taken together will give you risk of material misstatement, and this along with the detection risk, we call it to be what? The audit risk in togetherness. Correct? Then moving on to the next one. Now look at here how they are giving you. Same thing which I have explained you. So audit risk includes what? Risk of material misstatement, which we call it basically as ROMM. Along with that, it includes detection risk. Risk of material misstatement includes inherent risk and control risk. Whereas the detection risk will include sampling and non-sampling risk. What is that? Individually will come one by one. Or you can also show the relationship like this. Audit risk is nothing but inherent plus control plus detection. Correct? The same thing I discussed here. I told you audit risk is what? Inherent risk, control risk and detection risk. These three are the components out of which inherent and control together collaborate and make it risk of material misstatement. Along with that, you add on the detection risk. Together they become the component of the audit risk. Correct? Then one very important thing you need to understand is from the client side, the risk which is present, they are inherent and control. From the auditor's point of view, the risk which is present is the detection risk. Okay. Once again, looking at the client or the business of the client or the nature of the client's business or the entity, what all risk we come across will be inherent and control. But by the procedures performed by the auditor, which risk comes across, we call it to be detection. So from the client's side, the risks which are coming up are inherent and control, and from the auditor's part, the risk is what? Detection risk. So I told you inherent plus control plus detection risk together will make it an audit risk. Alright, now the auditor can only influence detection risk. I told you, if you look at here clearly, I told you detection risk alone comes from which side? The auditor's part. Whereas entire risk of material misstatement is based on the client side. So client's business, client's nature of activities, all of this is going to influence the risk of material misstatement. Whereas from the auditor's perspective, it is going to be detection risk. Alright, so that is what is given here. The auditor can influence only the detection risk, as inherent and control risk are influenced by the client. In order to reduce the audit risk to an acceptable lower level, okay, now look at the concept properly. Tell me, if you do the entity's auditing, what is already there in the entity, can you change that? That means there are risks like inherent and control risk. I'll explain you what they are. There is inherent risk, there is control risk, which is going to be present. Tell me, it is in the client's business. Is it in your control? No. So that risk you cannot reduce. It is going to be as it is. On that, you can analyze the risk and think of how audit you will conduct. That risk is going to be there. It is going to be unavoidable. What is with you or what you can influence is the detection risk. So detection risk will get influenced by the auditor. So in order to bring the audit risk to an acceptably lower level, the auditor can only reduce detection risk. He will not be able to reduce inherent and control risk, because that is in the influence or in the control of the client. It is in the nature of the client's business that these risks are going to be there. Those cannot be changed. Those cannot be eliminated. We study them for the purpose of audit, but changes cannot happen. But yes, detection risk is under our control, and there changes can be made by the auditor. Got it? So what they are saying is, in order to reduce the audit risk to an acceptably lower level, the auditor must reduce the detection risk. For example, by assigning more experienced people to the audit team, performing a wider range of procedures, and testing a larger sample. I would recommend none of you try to understand this as of now. When I explain you the concept of detection risk, I will get you back on the same page, and then every example given here will be understandable by you. Alright? So first we are going to talk about the risk of material misstatement, which simply means inherent risk plus control risk. Okay, now before we move on reading and understanding, I will give you a proper understanding of all of this. Now you will get introduced to a standard called as International Standards on Auditing 315, where the standard itself says that the auditor has to identify and assess risk of material misstatement by understanding the entity and environment. Okay. So what ISA 315 tells us, the auditor has the responsibility to identify and assess the risk of material misstatement by understanding the entity and the environment along with the internal control system. Okay. So what do you mean by this? So this ISA 315 tells auditor has to understand risk of material misstatement, which is what? Inherent plus control. To understand the inherent risk, you need to understand the entity and the environment. But to understand the control risk, you need to understand the internal control. Correct? So what they are telling here is, the risk of material misstatement is the combination of inherent and control. To understand the inherent risk, you need to understand the entity and the environment around it, and the controls you have to test so that you understand whether there is control risk or not. Okay, now what is all this? What is inherent? What is control? You must not be very clear with it. So let us have an understanding with an example. Now, inherent risk is going to be that risk which is going to be present in the organization. It is going to be unavoidable because of the nature of the client's business, because of the type of business which is there, because of the kind of infrastructure that you have, because of which it is going to be there. It is unavoidable. So those risks which are going to be present, we call them to be inherent. Like, to give a very simple example, suppose you go to a particular entity which is using entirely electronic data, computerized environment, totally CIS. Okay, now tell me, you as the auditor, when you go to do the audit of an enterprise or an entity which is having entirely the electronic basis or the computerized system, as soon as you go, you realize the possibility of risk which are going to be there. So what risk will you check? That yes, there is going to be a possibility of hacking of data. There could be data getting corrupt. There could be loss of data. Data could be tampered. Data could be lost because of lack of backup. People could have unauthorized access to the data. Okay. So there could be multiple risks which are associated. So these risks which I have analyzed only by understanding the entity, I call it what? Inherent. It is going to be there. It is unavoidable. Because of which there is a possibility material misstatements could happen in the financial statements. Because if the tampering of data is going to happen, financial data is what misleading. If somebody does an unauthorized access and change the data, it is going to change. Are you understanding? So basically what idea here is, when I visit the client, when I'm having the understanding of the entity, all the risk which I identify, those we call it to be what? Inherent risk. This is because of the nature of the entity, because of the kind of business they are doing, because of the environment in which they are. Like one more example to give you, suppose billing, okay, manual billing is happening. So you will see that there is a manual billing which is happening. So you know there is going to be a possibility of duplication. There is going to be a possibility of overwriting. There could be a possibility that there could be some kind of authentication issues would be there. Correct? So these risks are being exposed to. So these are what inherent going to be present. Correct? Similarly like that, inventory. When you look at a manufacturing organization, inventory is huge. Looking at the quantum, looking at the complexity, I understand, yeah, inventory is going to be a risky area. So this is what inherently it is going to be present. It is there in the business. So those risks which is assessed by the auditor, by understanding the environment and the entity, we will be understanding it to be what risk? Inherent risk. Because of the inherent risk, there is going to be a possibility that financial statements are what? Going to be misstated. If suppose inventory is an item which is going to have a possibility of risk being present, so tell me there could be a possibility that's huge inventory where obsolete items you are not able to identify or not able to segregate, because of which maybe the valuation of inventory is going wrong, because obsolete items and regular inventory items cannot be valued in the same manner. So there is going to be IAS 2 valuation of inventory which is going to give valuation norms. So if you do it wrongly, it is going to be material misstatement. Correct? So these things which are going to affect the account of transactions, balances, everything, these we are going to see as understanding the entity. These risks we call them to be inherent risk. One very important thing to understand, inherent risk we understand as if controls are not there only. That means management has not put any control. Without the controls, we are assessing, these are the risks. Those risks we call them to be what? Inherent risk. So the risk which the auditor will study without taking into effect or consideration the controls, we call that risk to be inherent risk. Alright, then. Moving on to the control risk. What is control risk? Let us give the same example of a computerized environment. So you, the auditor, entered in, you did the observation, you inspected certain documents, you understood the software, everything in detail. There you came across the inherent risk as what? Tampering would happen, hacking could be possible, unauthorized access could be there, the data could get lost because of no proper backup, etc., etc. So these are all the risks that you identified only because understanding the entity. But then tell me, management is doing a business. Don't you think they will also analyze the risk and they will take all the proper procedures to mitigate the risk, right? So these steps taken by the management to mitigate or eliminate the risk, we call it to be internal controls. So these things which the management will be using, we call them to be what? Internal control. Okay, now, suppose in the example which we have given, I told you there is a possibility of hacking to happen. Maybe some unauthorized access is going to happen, or there could be some kind of, entry of a virus, alright? So there could be a possibility of anything. So in that case, management will not ignore this because management also knows they are working in CIS. So management will put a control over it, and the control will be what? Maybe they will install the firewalls. They'll be able to detect, right? If firewalls are placed, then the virus entry and all will be gone. Or maybe you say antivirus in a simple language. Okay, where anything which is unauthorized will be stopped from the external sources. Similarly, you say, okay, there is a possibility of unauthorized access. People who do not have the access would, get access to the data and they could tamper the data. So management also realizes. So management puts what control? Maybe they will issue usernames, passwords. So this is the control put in by the management. Correct? So controls are put by the management for the purpose of preventing the misstatement. And if suppose preventing cannot happen, at least the control should be able to detect and correct it there. That means suppose if I don't have I have the username but I don't have the accurate password, will I be able to access? No. So first of all, I did this because I wanted to prevent the unauthorized access. Even then we have experts people who can do all the kind of permutations and combinations and do a cheating. So obviously your control should be so strong that if there is going to be some unauthorized access, so you could put a control such that maybe 2 or 3 times somebody tries, the system gets locked or maybe the account is getting locked. Okay. So here the control is not able to prevent, but it is able to detect and correct immediately. That means it detected somebody is trying to do an unauthorized access and immediately it corrected by locking the system. So nobody will be able to do what? Unauthorized access. Correct? So that is called internal control. But then what is control risk? Very simple. When the control put by the management to eliminate the inherent risk, if this control is not working, we call it to be control risk. That means the control is not able to either prevent or detect and correct material misstatement on timely basis. We call it to be what? The control risk. So tell me in a very simple language, if suppose there is inherent risk present and on that we put a control, so maybe unauthorized access. That means you are understanding it's a CIS environment, so there is going to be unauthorized access, risk is present. Management put a control of issuing username and password. But this control was breached by one of the employees. That means they hacked the password or maybe they, did any other kind of, somebody was typing and the person did not log out and they immediately accessed. So there has been a breach of control. Tell me, these two together, will it not result in risk of material misstatement? So because the control is breached, the person can do now tampering, unauthorized access can be given, so data can be altered. So don't you think it is going to account to material misstatement? Yes. And therefore we say risk of material misstatement is the combination of both inherent and control risk. I believe with this example, you will be able to understand the concept very, very clearly. Alright, so let us see what it is telling. As I gave you the introduction to ISA 315, identifying and assessing the risk of material misstatement. So what they say is, the objective of the auditor is to identify and assess the risk of material misstatement, whether due to fraud or error at financial statement or assertion level, thereby providing a basis for designing and implementing responses to the assessed risk of material misstatement. Now it looks very complicated. What they are telling is, we are going to assess the risk. ISA 315, we will do risk assessment. But risk assessment alone will not give you basis for drawing opinion. This is only going to help you to design your further audit procedures. So after you understand, this is a particular area of risk, inventory risky, debtors risky, okay, collections, bank transactions, some risk is involved. So you will identify the risk. So only identifying risk is not enough. This identification of risk will help you to implement response to the assessed risk. So these risks will take you to the next ISA, which we call it to be 330, where we will be designing the responses to the assessed risk. So whatever risk we identify in 315, we will respond to that in 330 and basically on that we will be able to give the opinion. Correct? So in 315 we will identify, 330 we are going to assess, that means we are going to perform procedures and check whether really misstatement is there or not there. Based on that we will give the audit report. Correct? Now, understand, it's only identifying risk. Risk is a doubt. When you identify risk, it is not a conclusion, error is there. What is risk? Possibility in this area, error could be there. So it could be error, it could be fraud, anything. Any of these things we call it to be risk. Anything that can affect the decision of the auditor. Correct? Then. Now they have given you a very simple understanding of what is misstatement. Very easy. What has to be and what you have done is not correct. That is misstatement. So what you were supposed to report, the way you are supposed to classify, the way you are supposed to present, or maybe the disclosure. It was required by the FRF in such a manner, and you have done something different, that means there is no correlation. We call that to be what? A misstatement. For example, it was supposed to be recorded as a capital expenditure. It had to be shown on the asset side of the balance sheet. But you have taken it as a revenue and you have done the wrong classification and taken to the P&L. So there has been a wrong classification. So this wrong classification is nothing but what? A misstatement. Similarly, disclosures. Maybe the disclosure requirement as per the financial reporting framework is clearly telling you that you have to show the remuneration payable to the directors separately and other employees separately. You have not done. So what was required and what is not done is not matching. Correct? In that case, that particular scenario, we call it to be what? Misstatement. So here you need to identify areas of financial statement where misstatements are likely to occur. Okay, so these are these are the areas where usually misstatements will be there. Once you identify, see whether the areas are significant. Significant as it could be fraud. If anything is going to be an indicator of fraud, we call it to be significant. Anything which is very complex, significant. Maybe a related party transaction, by the very nature, significant. Anything unusual, very nature, significant. So we'll identify whether they are significant. Then we'll carry out an efficient, focused and effective audit, and then reduce the risk of issuing an inappropriate audit opinion to an acceptable lower level. See, understand, by doing all this, we are only one motive is to reduce the audit risk of giving inappropriate opinion to an acceptably low level. What acceptable level is? Acceptable low level. And minimize the risk of reputational and punitive damages. That means if you give a wrong report, your firm will have a problem. That means damage to your reputation. And trust me, we are known for our dignity. If our dignity is gone, nobody is going to give work to us. Okay? So it's we having the degree without a degree. Alright? So this giving a wrong opinion will definitely bother the intended users, and because of which your reputation will be damaged. Alright? Then the next point of discussion talks about three categories of misstatements that we have. Factual misstatements, a misstatement about which there is no doubt. Like for example, you have realized that yes, there has been an overstatement of inventory. You know it, it's factual, it's done, it is a misstatement, no question asked. Judgmental. Judgmental are like, where estimates are involved, depreciation, provision. Okay, these are the places where auditors estimate and management estimate sometimes does not matches. So the auditor feels what? At this point of time, we feel it is unreasonable. So these are judgmental misstatements. Projected misstatements are very interesting. We have something called as, when you project the misstatement, like to give a simple example, we do sampling. What is sampling? Maybe if there are 1 lakh transactions, all of them we cannot check. So from them we pick few of them and we do the checking. Whatever we checking we do on the few transactions, we tell the opinion on the entire population. So 1 lakh sales, out of which maybe 500 if I check. These 500 I check and give opinion on the 1 lakh. So this is called projection. Projection means on checking 500, the projection that I do on the entire population, risk is involved there also. Correct? So that is what projected misstatements. Alright? So what is there in the sample? How you are going to project that misstatement to the population. When we come to the respective standard, we will be studying that even more in detail and you will get even a better clarity. Alright? Then. Now comes to the main point of discussion which I already explained, and now this will 100% make sense to you. Just for a quick recap, what is inherent risk? A risk which is going to be present. Why? Nature of the entity. And because of that, you will study the entity, understand the areas where risk could be there, and those risks you are going to read as if no controls are there. Though controls would be there, but you, when you are doing the assessment of inherent, you are going to assume controls are not there. Correct? So inherent risk is what? Susceptibility is what? Possibility of an assertion about what? A class of transaction, account balance or a disclosure to a misstatement that could be material before consideration of any related control. So what they are telling is, what is assertion? Maybe valuation is wrong, maybe measurement is wrong, maybe the existence, that means it is really there or not there, could be wrong. Correct? Assertions, we understand in detail, they are what management is telling us. They are claims made by the management. So when a loan is appearing in the balance sheet, management is telling what? This is our obligation. So this obligation is an assertion made by the management. So we have to just verify whether assertion is valid or not. Correct? So it is the possibility of the assertion. Let us take the example of valuation as of now. We will take the assertion valuation. About a class of transactions, so it is P&L account. Account balance means nothing but balance sheet item, or disclosure nothing but notes to accounts. And we will know that all these three together account for what? Financial statements. So when you talk about class of transaction, you are simply talking about P&L account items. Account balances are nothing but balance sheet items, and disclosure, that is notes to accounts. That these could be materially misstated. Okay? And when we are checking these misstatements, we are not going to give any regard to the internal controls. Without the control, if this risk is there, that risk is what risk? Inherent risk. Alright? Now let us understand some of the examples given here. Complex accounting treatment is an example of inherent risk. For example, suppose if there is a valuation norm, or maybe one of the international standards on accounting standards have given a principle of valuation, maybe impairment or something like that, which is sometimes gets very complicated, very complex. Or maybe the buyback price calculations and all sometimes do become very complex calculations. So there could be a possibility that because of the complexity, because of the difficulty, because of the usage of that particular standard, there is a possibility that this could be a risky area. Correct? So here what they are saying, where an accounting standard provides guidance on a specific accounting treatment, this might not be understood by the client, resulting in what? Material misstatement. Not only this, today we are in the verge of all dynamic environment. Every now and then we see new guidance notes, we see something new which is coming up, there will be new standards, there will be new treatments given. So every time something new comes, the user in the one go will never be able to understand anything in full. There is going to be gray area where things are not very clear. So in that case what happens? You as an auditor will realize new accounting standard, application possibility risk is there. This is inherent. It is going to be there. Why? Nature of the standard is complex. So their application is there. So there is going to be a risk. So this is what? Inherent risk. Correct? Then, inherent risk can arise due to the nature of the industry. I told you time and again. Of the industry, entity or nature of the balance itself. Sometimes the entity is specific to only an entity. Maybe like computerized environment. So maybe in that industry, everybody has all types. Like some are having manual also. Some are in CIS. So CIS is prevalent only to your entity. So it could be entity specific. Or it could be by the nature of the balance itself, like provisions. Now provisions are estimates, right? So your risk is going to be there, inherent. Alright, then. Here they have given the same example, inventory is inherently risky. So that is quite understandable. And we are also told, I give the example of valuation, assertion. So here also the example is correlating. They are also telling it is not valued properly. So obviously you know that you have to value the inventory at lower of cost or NRV. And if you don't do that, then that is not acceptable and it is wrong. Even obsolete items, you cannot do the accounting like that. There is a different treatment for it. So if you do a mistake there, it is going to be amount to what? Material misstatement. So inherent risk may be qualitative or quantitative. So it includes what? Complexity is there, subjectivity again the provision based on the factual evidences and all. Change, anything change, inherent risk. Some new laws today. Suddenly applying the law, are you going to be able to apply everything? Will you understand everything? No. So many things happen, fiscal laws change here and there. Every time a new budget is coming up. So tell me, when you read the budget on the first day, will you be able to interpret it perfectly? No. Then there will be if, but, why. Okay, so anything new which comes up, inherent risk is going to be there. Uncertainty. Okay, then susceptibility to misstatement due to management bias. If management only is involved in the misstatements, nothing you can do. So the integrity of management becomes very important. Because understand, if management is not having any integrity, controls anyway will fail. So that is inherent risk only. Correct? However good the control is, very strong internal control, at the top the management is what? No integrity. Absolutely. Gone. No objectivity, they are biased. They are partial. In that case, inherent risk it is. If the management attitude is not correct, it is an inherent risk. Risk of material misstatement 100% going to be there. Correct? So these are all the reasons, like qualitative inherent factors they are. Okay, complexity I explained you, subjectivity based on facts, changes, it's going to happen every time. Uncertainties are involved, alright, you never can predict everything. Then susceptibility of the management bias if they are not integrity, they don't have to have integrity in them. Then comes to control risk. I told you inherent risk are eliminated or mitigated by the management by putting internal controls. But if the control is not able to prevent, detect and correct any misstatement on the timely basis, that risk is called as what? The control risk. Alright. So the control risk is the risk that the misstatement that could occur and that could be material will not be prevented, detected and corrected on timely basis by the entity's controls. So the entity has put the internal control, but the internal control is neither able to prevent nor it is able to detect and correct on timely basis. Then there is going to be control risk because control is a failure then. Correct? Then the client should have control in place such as authorization. Authorization example would be like, for example, suppose you want to buy a particular machinery in the organization. So do you think the person in the factory can order the machinery? No. There has to be authorization. So he will simply raise the invoice or he will raise the request. This will go to some senior official. The senior official will authorize it. Then it will go to the finance department where they will authorize the, the amount to be sanctioned, everything. So there is going to be authority by authority where this sanctioning will happen. So it's a control where if this control is not there, then the factory guy can do anything. Any number of machineries, anytime discard, sometimes take machinery home also. Alright. So they could do that. So authorization. Segregation of duty, again the same. The person who will maintain the records and have the physical control should not be the same person. Then reconciliations, we do BRS. Physical controls, like for example backups. Okay, backup is a very important data, very, very important legally also and also for your, requirement. So these you cannot keep on local, you cannot keep it on the local servers or you cannot keep on the regular computers which are there. So wherever the backup is stored, you'll have physical controls also. You will keep that area to be a restricted area where outside clearly the banners will be there, restricted access only, or they'll be locked all the time. Okay, so these are physical controls, correct? Why you have these controls? To prevent, detect the misstatements occurring when the transactions are initiated. See, username and passwords are controls for initiation. Processing is when, if there is a wrong entry, the data should not be processed. That should be the control that you have. Recording also. Alright. So when I tell only this person can enter the data, only that person can enter the data. Nobody else. These are the controls put by the management. But if these controls are not working, anybody initiating, anyhow processing, anyhow recording is happening, controls are bad, and that is a situation of what? A control risk. Understand, control risk can be both. Control not there or control there but it is ineffective. Got it? Then, if the controls are not effective, control risk will increase and there will be a greater risk of material misstatement occurring in the financial systems. Correct, right? First you assess inherent risk. To mitigate inherent risk, there is going to be control. But if control also is not working, then what will happen? Risk of material misstatement is going to be very, very high. Problem. Correct? Now, so this is what inherent and control. Now we move to the third component, which is detection risk. Detection risk go by the word detecting, looking at it. Correct? That means it is a risk which is coming as a part of the auditor, that what procedure he is going to adopt to obtain the evidence is not able to detect the material misstatement. Okay, so that is what detection. The procedure that is adopting, like for example, suppose he decided to choose, maybe we are doing sampling also one of the procedure, right? So maybe you decided to choose sampling as one of the audit procedures and you were checking debtors. So you decided every month, first 10 debtors you will check. So the sample that you chose was what? First 10 debtors. According to your understanding, these debtors had no misstatement. Correct? But every month, last 5 transactions had misstatements. Now tell me, the auditor chose these things to check. So he chose the first 10 transactions to check misstatements are there or not there. According to him, misstatements are not there. But every month, last 5 transactions are misstated. Could he detect? No. That is called as what? Detection risk. That is because of something which has gone wrong, the auditor is unable to detect the misstatement which is present. And that risk we call it to be what? Detection risk. Correct? So the procedure adopted by the auditor, which is not helping him to detect the misstatements which are present, we call that risk to be what? A detection risk. The risk that the procedures performed by the auditor to reduce the audit risk to an acceptably lower level will not detect a misstatement that exists, and that could be material. That means it is existing and it is material, but the sample that you chose is not helping you with that. So it is the procedure chosen by the auditor to reduce it to the acceptable lower level, but you are not able to identify those which are already existing and they are material. Correct? So as they are already telling you, detection risk comprise of sampling risk and non-sample. So the example that I gave you is what? Sampling risk. The risk of giving a wrong opinion because the auditor chose a wrong sample. That means what? Here the samples that I chose are wrong, right? Because of which I am giving wrong opinion. So this risk where I am using a wrong sample is called as what? Sampling risk. On the contrary, non-sampling is what? Any risk or any reason other than choosing a wrong sample which is going to enable the auditor to give a wrong opinion is called as what? Non-sampling risk. Like for example, maybe you could not evaluate the evidence properly, your interpretation was not correct, maybe some of the risky areas you could not evaluate only, the experience of the auditor was not very clear in that particular department, correct? So these are some other reasons because of which risk is there. Okay, lack of experience is also one of the reasons, right? But that is not connected to sample. So those we call it to be non-sampling risk. The risk of giving a wrong opinion which is not connected to choosing a wrong sample, we call it to be what? Non-sampling risk. Clear? Then. Now, so what we have understood basically, if you have clearly taken the point properly, we are telling, so audit risk basically, we are telling first you study the inherent risk, then you study the controls. If you feel controls are good, then maybe the detection risk, you could choose smaller samples and you can do the checking. But always there is going to be a possibility of detection risk. So if all these three taken together will give rise to what? Audit risk. Okay. There is one connection or one of the understanding which you should take home here is that always understand there is going to be inverse relationship between risk of material misstatement and detection risk. Inverse relationship. That means if suppose risk of material misstatement is high, so according to you controls are not good, inherent risk are there, so risk is very high. In that case, tell me, you as the auditor, will you choose a small sample or big sample? You will choose bigger sample. When you choose bigger sample, that means more number of transactions for checking, you will be checking more. Because of which your detection risk will come down. Because your risk of material misstatement is high, your sample will be bigger, because of which your detection risk will go down. Because you will see more and more, right? So when you check more and more, detection risk will come down. On the contrary, if risk of material misstatement is less, okay, then obviously sample size you choose will be small. Risk is less. Now I will check more. I will check little bit, but I will check obviously. So less. Here I am not checking more transactions, so detection risk is what? High. So understand, our very objective is what? To reduce the audit risk to an acceptably lower level. And this can happen when you create inverse relationship between risk of material misstatement and detection risk. So in order to bring the overall audit risk to an acceptably lower level, you have to develop inverse relationship between risk of material misstatement and detection risk. This is something conceptual, this you need to understand. So we need to have a proper note of it, that there is going to be inverse relationship between risk of material misstatement and detection risk in order to bring down the audit risk to an acceptably lower level. I believe you all understand this. Okay, then. The auditor must amend the audit approach in response to the risk assessment to ensure they detect the material misstatement in the financial statement. Obviously, Once you do the assessment of risk, you will then decide the procedure in such a manner that you should be able to detect the misstatements. This can be achieved by emphasizing a need of professional skepticism, which I'll be explaining you now. What is that? Assigning more experienced staff to complex or risky areas of the engagement. Obviously, more experienced people will be able to detect better. See which sample to choose. First 10, last 10. An experienced auditor only can decide. Okay? Then in order to reduce that risk, use experienced people. Inexperienced people on the field, they will end up choosing a wrong sample. So detection risk also will become high. So in that case, audit risk will not become reduced. It will not reduce to acceptable lower level. Change the nature, timing and extent of the direction and supervision of the members of engagement team and review their work. More risk you identify, more procedures you will apply, and you have to supervise also them. Incorporate additional elements of unpredictability in the selection of further audit procedure. Incorporating additional element of unpredictability. Sometimes even surprise visits are recommended so that you'll be able to detect what is the scope of misstatement. Alright. So all of this we will not take up now. When we do ISA 330, that time we'll be discussing, because as of now you'll not be able to make proper sense out of it, because 315 is telling you to identify, 330 tells you to assess. And before you assess, you'll be studying something called as performance materiality, which we will be studying as a part of ISA 320. And only then you'll be able to understand what are all the other things. Okay? Then, let us take something which will definitely make you understand a particular concept now. That is the meaning of the word professional skepticism. Professional skepticism, in a very simple language, is the attitude of the auditor to keep questioning or to be alert when there are some doubtful situations. If there is any indication, okay, then you will be alert. For example, you come across a particular invoice, maybe a manual invoice, okay. So it is handmade, it is handwritten invoice. When you came across the invoice, maybe it is a sales invoice, okay, it's an invoice, a sales invoice. Yeah, there is number, everything is written and all. You see that there has been rupees 10,000 written. Then there is some scribbling happening over that, and it has been restated to 9,000. Now tell me, you as the auditor, when you come across this, don't you feel you are going to question the management? Why did you overwrite? Why did you do such kind of correction? Why was this incident happening? Don't you think you'll have, or you'll accept, must be there's a mistake, they must have erased and done it. Will you keep that attitude, or you will have a questioning mind? You will definitely have a questioning mind. So this situation indicated in the mind of the auditor, something is wrong. This something is wrong told the auditor, let me go and inquire with the management. Let me understand why. So this why which came in the mind of the auditor is called as what? Professional skepticism. The attitude of the auditor to keep questioning as and when there is a situation or doubtful situation arising, as and when there is a need for him to, understand a particular situation, or maybe there is a dubious thing, something which is suspicious, he simply cannot keep numb. He has to speak. He has to question. Almost it's like an interrogation. He has to ask why, when, what, who. All of these questions. This questioning mind of the auditor for the purpose of doing critical assessment of the evidence. See, this is an evidence, right? This invoice is an evidence. This evidence is making you doubtful. So for the critical assessment of this evidence, you are going to question. And that attitude of the auditor, we technically term it as professional skepticism. So when you see inventory and you see every inventory is kept in shelf, one after the other, properly numbered, but there is one shelf completely, empty, and they have started layering the next shelf onwards. So when you see one particular shelf totally empty, why? Doubt comes in your mind. There could be genuine reason with the management. Here there could be a genuine reason that actually there was a mistake of recording 9,000 and 10,000. There could have been a genuine mistake, which the auditor would cross-verify by looking at the bank transaction, or maybe you call the debtor, external confirmation you could obtain. You could do some additional procedure and you can find out. But there could be a genuineness behind it that genuinely it was a mistake. Or maybe when you were doing the inventory physical verification, there was a particular shelf completely empty. So there could be a possibility a leakage is there, or there is some kind of problem with the shelf. So they could have answered for it. But tell me, you as the auditor, will you be quiet looking at the situations? No. You will question. So this questioning mind of the auditor, we call it to be professional skepticism. Alright? Professional skepticism, an attitude that includes a questioning mind. Very interesting. A questioning mind, being alert to conditions which may indicate possible misstatement due to fraud or error, and a critical assessment of the audit evidence. So let me connect to my example. It is the attitude, obviously it is the attitude of the auditor for questioning. So my question was why it is overwritten. Why? Because being alert to condition which may indicate possible misstatement. So I came across the evidence which made me think there could be a possibility of misstatement. Then, just to understand whether it is because of fraud or error, I did a critical assessment, a detailed assessment of this evidence. And that what I am doing is called as what? Professional skepticism. I believe it's quite understandable. Now, this requires the audit team to have a good knowledge of how the client's activities are likely to affect its financial statements. The audit team should discuss these matters in a planning meeting before deciding on the detailed approach and the audit work to be used. That means it's not only the auditor, it's the entire engagement team who has to be professionally skeptic. Everybody has to be alert to the risk which have been present. Professional skepticism is necessary for the critical assessment of the audit evidence gathered when performing the risk assessment procedure. Risk assessment is wherever you're trying to identify the risk, you have to be alert. If you look at the organization you're observing and all, and you see there's some area where there could be a possibility of misstatement, don't ignore. You have to start questioning. So that is professional skepticism. And assist the auditor in remaining alert to the audit evidence that is not biased towards corroborating the existence of risk or that may be contradictory to the existence of risk. Okay, that means any situation. So in the payroll, when you were reading across, you saw they are showing 40 employees. But obviously, auditor observes also, right? So when you're observing, you have seen in the organization 20 employees working. Doubt in your mind. So this payroll is an audit evidence. Your observation is also an evidence that you've obtained. This is not matching. So contradictory evidences are telling you why. And this questioning which begins by the auditor is professional skepticism. Alright? Then, professional skepticism is an attitude that is applied by the auditor when making professional judgment that then provides the basis for the auditor's action. That means what? First, you understood what? There is some mistake here. Or when you question the management said, no, genuinely it has not been overwritten. There was a mistake of writing 10,000, but we corrected and made it 9,000. You simply cannot rely on the management. To understand whether really 9,000 is correct, okay, what will you do? You will perform external confirmation request. So you will maybe send a confirmation request to the debtor and really inquire with the balance with him. Or you will check the bank transaction if the payment has already happened. It should match with 9,000, right? So here you will see that provides the basis for the auditor's actions. Whether external confirmation, check the banking transactions, what? They are the actions. The auditor applies professional judgment in determining when the auditor has audit evidence that provides an appropriate basis for risk assessment. So this is what the evidence which I have obtained, which is telling me I have done some of the risk assessment, risky area for me to check. So basically after I get a transaction like this, I will also do what? I will check few more sales transactions to see is it only one time episode or there have been overwriting in many transactions. Correct? So this is what we do as a part of professional skepticism. So we began telling that the auditor is required to obtain reasonable assurance. This reasonable assurance cannot be absolute. So we give only higher level of assurance we require. This higher level of assurance you can achieve only when you reduce audit risk to an acceptable lower level. When you can reduce to the acceptable lower level, when you obtain sufficient appropriate audit evidence. And about that we study as a part of ISA 200. Then audit risk we understood is the risk of giving a wrong opinion on the financial statements. So in order to not get sued from the intended users for our disciplinary actions happening against you, you perform the audit in such a manner that you reduce the audit risk to acceptably lower level. Then we studied the components of the audit risk, which is risk of material misstatement and the detection risk, where ROMM is the control and inherent risk, detection risk is sampling and non-sampling risk. As I told you, initially you don't understand these terms, but now tell me when I'm doing the summary again, you are able to connect with everything. That is the reason I was very clear. When we begin, these terms are going to be new, introductory, so they'll be a little difficult to understand. Now you'll be able to make everything properly fall in place. Audit risk is a combination of inherent, control and detection. Inherent and control comes from the client. Detection is under the control of the auditor. So here we know that we have to identify and assess the risk of material misstatement. That is, you have to identify and assess inherent and control risk. Inherent risk you can understand by the entity, its environment, and control risk you can understand by studying the internal control. This risk assessment that you do, we call it basically risk assessment procedures. These risk assessment procedures, based on that you cannot give opinion. This will enable you to perform further audit procedures. Okay, that means what to do next. That is further audit procedure. These will enable you to obtain audit evidence based on which you will give conclusion, and from where you will get opinion. That is the way you do it. Okay. Misstatement is the difference between what has to be there and what you have done. If it is not matching, there is a misstatement. Factual, which is obviously wrong now after understanding. Judgmental, where provisions are involved. Projected, from sample to the main population, when you do the projection, there could be misstatements. Inherent risk is susceptibility of ABCD. Okay, I simply remember it as ABCD. Okay, for you also ease of remembering. Account balances, class of transaction and disclosure, where account balance are balance sheet items. Class of transaction are P&L account items. Disclosure are notes to accounts. So any misstatement here without taking into consideration the controls. Okay, so that could happen because of the type of business. Okay, and then you have the control risk, where management has put the control by understanding the risk, but the controls are not functioning. So that risk is called as control risk. Detection risk is a part of the auditor, where auditor is not able to detect because of the procedures that he's adopted. So I gave you the idea that sampling and non-sampling. So when you choose a wrong sample, you will not be able to detect. So detection risk is there. Non-sampling is where it is a risk of not able to identify the risk, but that is not because of a sample, it is because of some other reason. Then last we studied about professional skepticism, where I told you it is the attitude of the auditor to keep a questioning mind. Whenever situations happen to be doubtful, when there are some kind of doubts in the mind of the auditor, he has to maintain a mind of questions, keep questioning, inquiring with the people around, so that he understands why it has happened. Only then we call it to be a proper audit conducted. Alright? And one very important element I told you, in order to reduce the audit risk to an acceptably lower level, you have to make the risk of material misstatement and the detection risk have an inverse relationship. Why? You have properly understood. So with this, we have understood a part of the risk assessment topic which purely talks about audit risk.
Hey, are you considering ACCA as a career path? Then you're at the right place. Call us at 9640 111110 or log into indigolearn.com or download our app OneFin by Indigolearn.